Emotional trading is one of the biggest reasons traders lose money. It does not matter if you are a beginner or experienced. It does not matter how good your strategy is. At some point, emotions show up. They show up as fear. They show up as greed. They show up as frustration and impatience. And once emotions take control, trading decisions change. In this video, I want to explain why emotional trading happens and how to stop it. Not in a quick or motivational way, but in a calm, realistic, step-by-step way that professional traders actually use. If you stay with me until the end of this video, you will understand why emotions are unavoidable in trading, why trying to suppress them makes things worse, and how to build the mental habits that allow you to trade calmly and consistently. This video is designed to be watched slowly. Each part builds on the previous one. If you are serious about trading psychology and long-term consistency, consider subscribing to Bull Mindset. This channel is about helping traders think clearly, stay disciplined, and avoid emotional mistakes. Now let us begin. The first thing you must understand is this. Emotional trading is not a weakness. It is a human response to uncertainty and risk. When you trade, money is involved. Money represents effort. Money represents time. Money represents security. When money is at risk, the brain reacts automatically. This reaction happens before logic. The brain's job is to protect you. So when price moves against you, fear appears. When price moves in your favor, greed appears. When losses repeat, frustration appears. This is not something you choose. This is how the brain works. The problem is not that emotions exist. The problem is that emotions begin to control behavior. Professional traders understand this difference. They do not try to eliminate emotions. They learn to prevent emotions from controlling actions. This is the key to stopping emotional trading. Another important reason emotional trading happens is expectation. Many traders expect trading to feel calm. They expect confidence. They expect clarity. But trading is uncertain by nature. You never know the outcome of the next trade. When expectations meet uncertainty, emotions increase. Professional traders accept uncertainty fully. They do not expect certainty from the market. This acceptance reduces emotional pressure. Another reason emotional trading happens is poor risk management. When traders risk more than they can emotionally handle, emotions take over. Even if the amount looks small mathematically, it may feel large emotionally. Fear grows when risk feels painful. Professional traders choose risk levels that allow calm thinking. They do not try to be brave. They try to be stable. Another factor is emotional attachment to outcomes. When traders care too much about individual trades, emotions intensify. Every win feels important. Every loss feels personal. Professional traders do not think in single trades. They think in series of trades. This mindset change reduces emotional intensity. Now let us talk about how emotional trading shows up in real situations. One common example is hesitation. A trader sees a valid setup. Everything matches the plan, but fear appears. The trader waits for more confirmation. Price moves without them. Later, regret appears. This regret increases emotional pressure in future trades. Another example is exiting trades too early. A trader enters a trade. Price moves slightly in profit. Fear of losing profit appears. The trader exits early. Later, price reaches the target. This creates frustration. This frustration increases emotional reactions later. Another example is revenge trading. A trader takes a loss. Anger appears. The trader wants to recover the loss quickly. They enter trades without proper setups. Losses increase. This spiral is emotional trading in action. Another example is overconfidence after wins. A trader wins several trades. Confidence grows, risk increases, rules loosen. One loss wipes out progress. This is also emotional trading. Professional traders avoid these behaviors by controlling process, not emotion. Now let us talk about how to stop emotional trading. The first step is awareness. You must notice when emotions appear. Fear, greed, frustration, excitement. You do not need to judge them. You only need to notice them. Awareness creates a pause. That pause is where control exists. The second step is accepting uncertainty. You must accept that you will never know outcomes in advance. Once you accept this, the need to predict disappears. This reduces emotional pressure. The third step is defining risk clearly before entering trades. If risk is unclear, fear grows. Before entering a trade, know the maximum loss. Accept it mentally. If you cannot accept it, reduce position size. Clear risk leads to calm behavior. The fourth step is shifting focus from money to execution. When money is the focus, emotions dominate. When execution is the focus, emotions soften. Define success as following rules, not making money. This shift takes time, but it works. Now let us talk about mental frameworks professionals use. One important framework is process over outcome. Professionals judge themselves by behavior, not results. Another framework is probability thinking. Each trade is one event in a long series. No single trade matters much. This perspective reduces emotional attachment. Another framework is identity. Professional traders see themselves as disciplined operators. They are not gamblers. Identity shapes behavior. Now let us talk about practical exercises you can use. One exercise is pre-trade emotional check. Before entering a trade, ask yourself how you feel. If emotions are high, reduce risk or skip the trade. Another exercise is loss acceptance practice. Before clicking buy or sell, accept the loss mentally. If you cannot accept it, do not take the trade. Another exercise is post-trade reflection. After a trade, focus on behavior. Did you follow your plan? Did you manage risk? This trains discipline. Another exercise is emotional journaling. Write down what you felt before, during, and after trades. Patterns will appear. Awareness leads to improvement. Another powerful habit is routine. Professional traders follow routines. Same preparation, same execution rules, same review process. Routine reduces emotional decision-making. Now let us slow down and connect everything. Emotional trading happens because trading involves uncertainty and money. You cannot remove emotions, but you can prevent emotions from controlling behavior. Professional traders still feel emotions. They simply do not obey them. This is a skill built over time. If this video is helping you understand emotional trading more clearly, consider subscribing to Bull Mindset. This channel exists to help traders build discipline, clarity, and emotional control. Let me leave you with a final thought. The market does not reward emotional reactions. It rewards calm execution. When you learn to control behavior, emotions lose power. Trade calmly, trade with discipline, and think long-term. I will see you in the next video. Thanks for watching.